Hello and a warm welcome to Personal Finance. I'm Gugulethu. Cele. Today we tackle that D word, how to tackle the debt trap and make sure that you don't fall into it. But if you do unfortunately find yourself in that predicament, how to deal with that particular situation. Well, joining me in studio today to help us divulge more details on this, I'm joined by Nitesh Patel. He's the head of inclusive and middle markets at Standard Bank. Nitesh, good to have you with us today. Let's tackle this debt trap. Firstly, what does it entail before we actually discuss how South Africans find themselves in this situation?
So I think if you're battling to pay your debts every month, or you miss one or more payments, that's the first indicator that you're starting to be part of this debt trap. Mm-hmm. The second one is if you're borrowing money from micro lenders or loan sharks on a regular basis, you can consider yourself in the debt trap. Thirdly, if you're borrowing money from one financial provider to pay another financial provider, you're in a debt trap. You shouldn't be borrowing money to pay money back. Those are the three large indicators that you're starting to become part of this debt trap. Most people don't know it until it's too late. I think importantly is if you identify it up front that you're borrowing money, more money than you can earn, you'll be landing up in this debt trap quite soon.
And maybe we need to demystify some concerns here, because I think a lot of people think that only those who don't earn enough actually find themselves in debt traps. And I take it, regardless of how much money you earn, either way, if you have exposure to credit and use it incorrectly, you can fall into the debt trap.
Absolutely. So people who find themselves in the debt trap there can be a few reasons for them. On a macro level, it's the high unemployment rate in the country. And on a micro level, we start seeing things like people not understanding how they borrow money. So one is you borrow money to fund your status in life, like buying expensive clothes, etc. That's just not good credit. Good credit is when you can borrow money that will generate your income, or that for items that appreciate in value over time.
Give us some examples there.
So buying a home, for example, you know your home is likely to appreciate in value over time. It provides housing for your family. It enables you to live a better life. Enables you to live comfortably. So that's good debt. For example, a student loan or a business loan, those enable you to make more money. So those are good for you. Bad credit, like I've said, is when you borrow money to fund buying an expensive pair of shoes.
So we know that a lot of South African consumers don't do this necessarily intentionally, so to speak. But what actually gets us there? That differentiation between identifying the good credit, where it will be backed by assets and appreciation in your wealth creation, versus, you know, my expensive fetish in shoes.
Yeah. Again, most South Africans don't get into this debt trap deliberately. And many people take out credit to buy homes, to buy vehicles, to pay for their children's education, and that's okay. Then things happen in life, and things like losing your job, unfortunately, or being retrenched, and those changing circumstances in life suddenly result in you not being able to meet certain commitments. Fortunately, for things like insurance or disability, for things like disability or retrenchment, you can take out insurance to cover yourself against that.
So it's up to the consumer, together with a financial planner, to identify the right product for you, right?
Absolutely.
And do an accurate needs analysis.
Yes. Most people don't like paying for insurance, but it's shown that in examples like these, it pays to have that insurance. Secondly, you get people who then have to pay for expensive medical treatment, and those are again unforeseen emergency treatments that have to be paid for, and that's how people end up in this debt situation where they have to borrow money, and more money than they could repay back. The third piece is the one that we joked about earlier, where people are borrowing money for the wrong reasons. And that should just be avoided at all costs.
How do we change that mindset though, Nitesh, especially given the fact that credit is so easily available in the market? You can open up any clothing store account, various cell phone contracts. It almost seems as though there's no end to the availability of credit. Does it mean that as from a consumer, you need to be more educated in taking out the right credit for the necessary things, or being disciplined and go back to budgeting, where you work on a cash-only basis, if that's even possible?
I think it's a combination of both. So it all starts with a plan. And this thing called a budget, most South Africans are afraid of. I guess most people worldwide are afraid of. And putting a budget together is not that difficult. So I'll use my cell phone as an example. I record everything on my cell phone. So I record the cup of coffee I buy at work, the petrol I put in the car. I record everything on my cell phone because it's with me all the time. And that's what starting a basic financial plan is about. It's knowing what your income is, which is quite simple for most of us because we have one source of income. And then it's recording all of your expenditure on a daily basis. If you do this every day for a month, you are able to go and record what you've recorded on your cell phone. You're able to record it on a piece of paper or on a spreadsheet, and you start seeing what you actually spend money on. You start identifying that, are you spending more money than you're actually earning? And then, so part of this is identifying what kind of debt you have. You start by prioritizing the most expensive debt, and you pay that off quickly. And that's how you prioritize your debt. The most expensive debt first, and then the others thereafter.
Tell us what you mean by expensive, because I think that's a concept as well that we need to understand. You're not necessarily saying your home loan versus the value behind the loan isn't actually what makes it expensive. It's actually the interest being charged, right?
Absolutely. So you pay different interest rates on different kinds of loans. Shorter term loans, which are not secured by some kind of an asset like a vehicle or a house, those carry high interest rates because there's no collateral behind those loans.
Like a credit card or personal loan?
Absolutely. Personal loans from loan sharks, for example, would be most expensive. And your credit card, there are many financial institutions today who will custom make your interest rate on your credit card for you. And you can use your credit card quite wisely, actually. So credit cards offer you 60 days interest free, for example. And again, most people don't make use of that facility. It's 2 months of free interest that you get on a credit card. So if I had to prioritize, I prioritize any short-term personal loan above a credit card and so forth.
Let's get into the big question as well, which is if you find yourself begging Peter to pay off Paul and in a difficult situation where it's hard to actually keep up with those payments, is consolidation the answer, and are there other options that a financial institution can actually offer you as a client?
Yeah, so I think first priority for you is to talk to your, depending on how many loans you have and what kind of debt you have, you need to talk to your financial provider or the loan provider to see if the loan provider can renegotiate the interest on the loan or the repayment period of the loan. If they can't do that, then talk to your bank about debt consolidation. Debt consolidation is an option, but it's not always available. So what happens is people miss payments on their loan repayments. They then start affecting their credit record because you've missed the loan repayment. So when you go for debt consolidation, your credit record has been impaired, and you'll find it difficult to try and consolidate your debt because you wouldn't qualify for it.
Why is that though? Is it because if you were a regular payer, then they'd actually be more open to helping you consolidate your debt?
So my first advice to anybody is, when you identify the first signs that you are starting to battle to make loan repayments, go talk to the loan provider, any of the loan providers you have.
The typical response though, Nitesh, is I'm scared because they're going to threaten me and take me to the lawyers, and I just don't have the money to pay them off.
First step is approaching that fear and going to talk to them. If they are and the sooner you do it, the better. If you do it on the 29th of the month and your debit order goes off on the 30th, it's almost too late. If you do it well in advance, you know they've said no, then you can go to the next step of going to talk to your bank about assisting you or another financial institution around assisting you with debt consolidation. If you haven't missed any loan repayments, the chances of an institution helping you with debt consolidation is higher than when you've missed a couple of payments already. So debt consolidation is when they take all of your debt or some of your debt and put it into one longer term, cheaper loan. And then you're able to pay that off over a longer period, and hopefully it's cheaper than paying off many debts at the same time. The last resort available is also going to the National Credit Regulator and requesting what's called debt review. So what happens there is the National Credit Regulator would direct you to a debt counselor in your area. So that's someone that's been accredited by the National Credit Regulator, and this person would assist you in putting together a financial repayment plan, and they go negotiate on your behalf with all of the loan providers on one payment option. You stay within debt review for the period that you can repay all of your loans, and once all of your loans have been repaid, you can then come out of debt review.
Time to get the important key takeaway points from this evening's discussion. Nitesh, we've said quite a bit, and debt is a very uncomfortable topic for many people, but if we wrap it up for this evening, the 5 key points for consumers to remember when it comes to avoiding that debt trap.
First and foremost, I think most importantly, is don't take out bad credit. Know the debt that you're engaging in, know that you are able to repay the loan that you are taking out. Secondly, if you find yourself in trouble making payments, talk to your loan provider well in advance. Thirdly, financial planning. Extremely important, and it starts with a basic budget. Last but not least, if you really can't find help with any of your loan providers or with debt consolidation, go to the National Credit Regulator for help on debt review.
Thank you so much for your advice and giving us the red warning flags to be aware of when it comes to debt and the trap that one can fall in. Well, that's where we have to leave it for Personal Finance this evening. A big thank you once more to my guest, Nitesh Patel. He's the Head of Inclusive and Middle Markets at Standard Bank. Be sure to join the conversation and send us your points and suggestions to @CNBC Africa using the hashtag Finance410 or to myself @Gugulethu on Twitter. Until next time, it's goodbye for now.